Good morning, everyone. I hope we're all well caffeinated after the welcome coffee break. And welcome to our panel session on creating value beyond financial engineering. So my name is Sue Wei Wong, and I work for Hines, which is a private real estate investment manager, and I lead our family capital business. I think we heard it all from a lot of the panelists this morning, and we can all agree that it's been a very interesting decade for real estate. You know, we started the decade certainly with a period of very low interest rates and relatively abundant liquidity to quite the opposite environment today. So we heard that capital is becoming a lot more selective, and that cost of capital remains elevated today, and that path also remains pretty unclear. So how are GPs and credit managers navigating this new environment? So to help us unpack this, I'm really pleased to invite our panel of experts here this morning to the discussion. And also, given their backgrounds, they'll be able to give us some really quite different perspectives on how they view value creation. So just before we dive into it, I'm just going to hand over to them quickly to introduce themselves, their company, and what their focus is to help frame the discussion. So Matthew, maybe I'll start with you.
Hello. Yep, working. That's great. So Matthew Phillips, I'm a partner at Valor Real Estate Partners. We're a last mile logistics investor and asset manager. We only invest in last mile logistics, so we're a specialist, and it's on a pan-European basis. We have approximately 5.5 billion assets under management, and it's a granular aggregation strategy.
Hello, everybody. My name is Riccardo Bello. I'm managing partner and co-head of real estate team at Eurazeo. Eurazeo is a French private equity group with about 40 billion euro AUM. I co-lead the team of real estate. We invest solely in operational real estate, so we're typically in businesses that have to do with healthcare, services, leisure, hospitality, and other sectors in traditional real estate where the operation are key. We invest in small cap, and we help these businesses grow into a mid cap, typically.
Hi, my name is Susanna Peric. I'm responsible for private credit sourcing and origination at Oaktree in Europe across our investment strategies. And across different sectors, up and down the capital structure, so including opportunistic credit, direct lending, infrastructure lending, asset-backed finance, life sciences lending, and real estate.
Excellent. Maybe to kick it off, let's just sort of set the scene on how the environment today and maybe defining value creation and how you see that in your field. You know, if we look back 10 years, as the title would sort of suggest that, we might have focused on leverage and yield compression, falling rates, but what does value creation mean in the area where you focus on? And maybe ladies first, Susanna, I'll start with you.
Yeah, thank you. I'm happy to kick this off. So what we are seeing in this market is that it's increasingly characterized by dispersion. And what I mean by that is, a split between stronger and weaker borrowers. For many years, there was abundant liquidity, low rates, as you just mentioned in your intro. So that environment has changed quite a bit, and things are becoming a bit more apparent. From what we are seeing is that investors are very much focusing on businesses with resilient cash flows, strong competitive positioning, pricing power, and the ability to be flexible, nimble, and navigate especially a higher cost of capital environment. Refinancing visibility is key, liquidity and sustainability of the capital structure. So we do see that traditional investors are becoming a bit more selective, and in this market, it's absolutely key to have the flexibility and the expertise to find the right investments, and these should allow investors to reach attractive returns at hopefully a little bit more tighter structures.
Ricardo,
yes. So we are at our fourth fund, And we had to think a little bit about the strategy, how to move forward. Our background has always been more opportunistic, pure opportunistic real estate. And we have done historically about 40% in what we buy, fix, sell real estate, whether it's retail, office, logistic, residential, and about 60% more. What used to be quite niche operational asset, where we were typically majority owner of real estate and the business operated in the asset. And looking back and reflecting on what we have done and the outcome that we have had in our investment, we feel like that in this uncertain capital market, it's difficult to be opportunistic because you have very little visibility in 3 to 5 years down the line where the capital market is going to be. Is it going to be driven by yields compression? Well, not quite sure. There is inflation going on and a lot of macro geopolitical. So we decided to focus on operational real estate. And the reason to do that is that we can acquire in some of the vertical going concerns or business and real estate together very high yield. We're talking about double-digit or single-digit EBITDA multiple. We put a conservative acquisition leverage at 50% of the value of the company, and we are in the high teens and cash on cash, while we deploying capex to scale up the business by acquiring other smaller businesses in the same sector, and private equity style realizing synergies in central cost and overhead, so no capex investment. And selectively, we also would do capex or organic development through development of newer asset or conversion. So we find that overall we can generate an opportunistic level of return with a fairly low level of risk, because a lot of the return comes from the income on the asset, not just a speculation on the exit eventually.
Sure. So value creation at Valor Real Estate is all about specializing. So we're last mile, and that's true last mile logistics in gateway cities. So London, Paris, Berlin, Amsterdam, Rotterdam, and now Milan, as I was mentioning to Riccardo earlier, are key cities for us. And how we generate that value is by having better data than anyone else in those cities. So it's boots on the ground strategy. And it is a combination of the investment team sourcing deals at better pricing, and the asset management team realizing that we can push on leasing that little bit more, and then the financing team having that network of lenders. So it's a team effort to generate outsized returns. But I think in any sort of field today, you need to have a specialism. I think the yield compression cycle has passed. And you need to find an edge. So that's what we're doing.
I think that sort of resonates with something the panelists said earlier today about either the large GPs or that specialism and having that specialism. But I'm sure Riccardo and Matthew, we can debate that a bit later. But Susanna, and everyone was speaking about it, but the higher interest rate environment that we're in, and you speak to a very wide range of investors. What are you seeing in terms of how they're navigating the refinancing risk and the tighter liquidity conditions today?
Yeah, so what we're seeing really across the board is that operational discipline is what matters more than ever, really. And that's to the points I mentioned earlier. So focus on cash generation, productivity, pricing discipline, and capital allocation, combined with strong management teams who, again, are flexible and able to navigate this volatility. And I heard this through the co-panels as well. I think experience is key. And so, you hopefully have a view how to navigate those volatile times and deal with market uncertainty. And from what we are seeing, and again across the board, is that the strongest businesses today are balancing both operational discipline with the ability to continue investing for long-term growth. But yeah, it's not easy in this market.
And are you seeing any particular sectors perform better than others? And how are investors, assessing these opportunities to invest in?
Yeah, I think it's always very tempting to look at sectors per se, and of course there are differences in sectors, and some by nature are more cyclical, and you probably need more expertise to navigate those. But the way we look at it is less from a sector perspective and more going back to fundamentals. So it's more down to companies and performance and all the aspects that I just mentioned, rather than sectors. So if you have the expertise and the flexibility, you can actually find very attractive opportunities within some sectors where other people maybe feel less comfortable acting, and those typically provide very, very attractive value propositions.
And you talk about fundamentals, and Ricardo, with your business, you tend to invest in real estate and companies that own the real estate assets that they operate. So you look very closely at the operational side. And how has your definition of value creation then evolved over the last 5 years, especially as you look at the changing macroeconomic environment?
Yeah, I think first of all we look at the underlying. What I always say, we are product first and real estate second. I mean, the reality is that 80% of the value of our investment is in the real estate, but the key is to have the right product. So for us, what is interesting, we're not a turnaround. We're not buying distressed operational businesses and turn them around. We want to find product champion. And so for us, the key metrics to generate value is to look at the intensity that the operation uses the real estate. Because if you have a modus operandi that generates a very high EBITDA per square meter, that means that you're very scalable. If you have a low EBITDA per square meter, it might well be that a business functions really well in a particular building, but it's not really scalable, because when I go in London, Paris, or Milan, in big cities to compete for real estate, I need to use the real estate efficiently. So for example, we just acquired, completed a week ago, an apart hotel business in Paris, and by going 100% room business, so over 70% margin, so eliminating the F&B, focusing on city center location where the F&B is provided by the local amenities, well, we have such a good use of land that we have now 20 buildings in the pipeline to scale this business up, because we can compete with people that do office to resi, we have better use, we can compete with hotel use, we have a better use. So that's really what we are after, trying to find this product champion. They use intensively real estate, that are in sector with tailwinds from a consumer perspective, and really go deep then. But you have to do all the private equity due diligence on the product, so that is almost double the work for the same fee, what I say sometimes to our clients.
Yeah, absolutely. You just sort of mentioned sectors there, and location is absolutely important. But as you look across your business and you look at living, hospitality, logistics, all of those sort of alternative sectors that you also participate in, is there any particular sector that you are more bullish on, or you're seeing a lot more of an operational edge, for example?
So for us, we were discussing this just before the panel. I think sometimes real estate pricing is driven more by capital flow than actually by the fundamentals, right? So when we design our fund, we didn't want to. There are some sectors that are really good from a demand perspective, but they're overcapitalized from a capital perspective, and then you become a forced buyer. So when we design our strategy, we kept it broad, because at the end of the day, we always look at three variables: is price, volume, and average length of stay, what we call. Whether it's a healthcare, whether it's a leisure business, these are the three variables, and we try to see value between the three of them. So for example, the first deal we did in the fund is a thermal, is basically a theme park of hot water and spas and so on and so forth. Well, you don't have average length of stay because people buy daily ticket, but we're actually in a piece of land in Italy where you have 25 million of people that can drive to the asset within 2 hours. So that, and then, you are a price power, because in winter there's very little to do in terms of leisure offering. Either you go skiing, but only 5% of the population skis. So we really like to be able to buy that at 12% yield, compared to do maybe something else in the same area, more traditional, would be 5% yield. So we try to find this arbitrage, working with these variables and reconducting all back. And where we see relative fundamental value versus the capital flow, that's where we play and we place our bet.
Excellent. But Matthew, you do focus on a sector, and a very specific sector at that. So, and you can disagree with it, but given the maturity of the logistics sector, do you think there are any misconceptions that LPs or investors still have about where value can be created within industrial assets?
Yeah, and I think it's a really interesting time for logistics because obviously the pandemic had a massive impact on logistics pricing, capital flows, but actually, in many ways, our strategy has remained the same. And it goes back to what Riccardo was saying there about product champion. We're actually not so different because we focus on the relative functionality of an asset in its submarket. So we're looking for the product champion of that logistics asset within its submarket. And if it's got a larger yard depth, it's got maybe more car parking spaces or excess yard that can be used for electrification and for trucks and charging. Those extra aspects of a property are what mean a future tenant is going to take that building. So not all logistics is going to perform well. We look for the buildings that will perform best within our submarkets. And I think to your point around maturity, just because cap rates sort of contracted materially, that part of the cycle is definitely gone. But the operational expertise of knowing your tenants better, knowing warehouses aren't just bonds that are 10-year leases, and how to actually improve those through ESG, releasing, and other operational sort of key parts of them. That's all of that comes together for how we generate value today.
And maybe just going a little bit deeper into that, so how do you differentiate, or how does Valor differentiate themselves? How do you find opportunities that others might miss? And maybe you could give an example of how you've really added value.
For sure. So we have a team of approximately 60 investment professionals across Europe. So it's a big team, and that's a team on the ground. So just like most people know their local street better than probably most investors from a residential perspective, we're just the same, but for logistics. And there isn't a right move for logistics, whereas we've built an internal database with a team that is our proprietary database of all the leasing and sales comps, which we can benchmark against wider databases. So we've got better information. That doesn't mean that you can buy better, but it does mean that you've got better information. And I think when you've got better information and you're an aggregation strategy over time, what we've seen over the last 10 years is our performance has been far stronger. So our average IRR realized today is about 50% IRR. A lot of that is from cycle, but even if we look at our unrealized returns, it's been extremely strong through the cycle, and that's because of, I guess, a focus on the fundamentals of the building, as I was alluding to before, relative functionality, and just sticking to discipline.
Yeah. And Riccardo, maybe I could bring you in on that point, because small specialist logistics versus like larger platforms where you can leverage scale. What do you add to sort of what Matthew was saying on that?
Well, what we do, we play we go in acquiring businesses that were between 100 to 200 million enterprise value. At that scale, we find a very interesting market because on one end, we have heavy operational platform that the real estate GP that have the competencies to look at this stuff. The deal is too small for them. So we don't find them on deals. Occasionally, there might be some real estate manager that venture out and try to do something a bit fancier in their opportunistic fund, but typically they are generally out. We see a lot of deals which are fade buyout, so coming from a private equity angle, and of course, Eurazeo being a big private equity, we have all that origination network too, whereby these businesses require capital expenditure investments by refurbishing, expanding, and buyout fund don't really underwrite CapEx. They want to sell and lease back. But at that kind of scale, the business is still too small for the real estate to be spun off. And of course, now there are no core buyers of real estate anyway in the market. So that's where we come in. We resolve that kind of complexity in the deal. We're typically the first institutional investor. So there's a lot of low-hanging fruit, but a lot of work in the acquisition, and we find a nice niche. When we scale them to 500, 750 at exit, and even sometimes bigger, we find that that's the peak of the liquidity in the European real estate private markets, because you can sell these to a larger fund at the same cost of capital. We would have made our return anyway. You can sell maybe the operation to a strategic that does a sales and lease back and sell the real estate to a core buyer if that exists. So there is a lot of optionality in the exit. And so you get typically an oversized return. This is what we have realized by having that capital market arbitrage, but we don't need to rely on the capital market arbitrage, meaning being able to sell the operation to a strategic and the real estate to a core buyer. We can also rotate assets, so it's nice to have that kind of optionality built in your investment, despite being a platform.
Yeah, no, absolutely. Susanna, Riccardo sort of mentioned it, but when you look at today's market environment and the way that firms are approaching sort of sourcing, has anything changed in the way that they do that, the underwriting, the capital deployment? What are you seeing on your side?
Yeah, I think especially the large managers are adapting very, very quickly. So when you have an abundance of capital, it is extremely important to have a strong sourcing and origination capabilities that allow you to see differentiated opportunities and be more selective, which resonates with LPs especially, because in this market, selectivity, I think, goes over volume, and the recent volatility was a good wake-up call for managers to appreciate that. So you will probably at some point see and be able to differentiate between managers who prioritize deployment versus fundamentals or strong underwriting skills. So I would say origination and sourcing is creating a big alpha for managers, because you just gain access to a lot of bilateral opportunities. You see more deals, you can choose, and that should allow you to create better returns for your investors.
Yeah. I think just sort of changing tact a bit, just touching upon AI. I think that AI and infrastructure seems to be the buzzwords these days. But as you look at advances in sort of data, technology, and AI, how is that changing the way that you're looking at opportunities or managing assets? And where are these tools genuinely creating value today? And where do you think the industry is overestimating the impact of that? And maybe Riccardo, I'll start with you.
Yeah, so Eurazeo is we have a quite fairly large venture capitals and growth equity investment platform. So we're kind of the forefront of technology, I would say. Because of that, we see a lot of stuff happening at a very early stage and so on and so forth. So we are a big adopter, long story short. We have been using some of the tools. Now, I would say, I think that really from February this year, without naming, there's been a big release of a very interesting tool that can summarize information to a very precise extent very quickly. So we use it quite a bit within the team to summarize large amount of information that we control in terms of perimeter into something that is readable and digestible. And that has revolutionized the way we do things within the investment team. And it will only going to be more and more, I suspect. It doesn't take investment decision, but really allows you to take a lot of the chore out
and summarize it.
Summarize.
Yeah, I think we're all...
So that's good. But we see that also in the businesses that we own, have even bigger impact. And I'll give you an example, like this leisure asset that we own, being a spa, we can't film or take pictures because people are in their swimsuit, right? But now we're able with AI to generate content with people using artificial intelligence to promote. And soon later this year, by going to the website, that will be tailor-made to you as a customer, whether you're a female, a male, of a certain age group.
So you just create images.
You will see different. So that allows you to sell your product way better, and that's really where it's gonna be extremely exciting. I understand very little of it because I'm a boring investment person, but the marketing people within some of the business that we own are extremely excited about the AI and the way they are empowered now to sell in a different way. They even just 6 months ago, they weren't able to do it.
And is there anything that, as you look at, the area that you're focused on, that you wish AI would step up a little bit, as in, where it's lacking?
Modeling, I think financial modeling. We say, I trust the junior in the team. They said is 80-85% there, but it's still is the part where we have to, of course, spend a lot more attention. One thing is to summarize data, to take decisions or get intuition, but the other thing is to really have the accuracy. And so we at the moment we don't trust the technology yet.
Yeah.
At that point.
I think that's probably the right approach. Because I think everyone types into Claude or ChatGPT, and because we're all so time poor, we just tend to believe the output of that, which is not necessarily what we should be doing. Matthew.
Yeah, and I think, look, picking up on where Ricardo left off, it doesn't replace judgment. So yes, it speeds up analysis. If you've got proprietary data, that is very helpful as well, because it can ingest that and give you some additional analysis. But ultimately, someone needs to make a decision. And so we certainly use it for lease abstraction, a lot of the low-hanging fruit of administrative tasks. But actually, I think probably the bigger impact on logistics is going to come from, and again, adjacent to what you're saying, Ricardo, people buying more online, because we've seen e-commerce growth from approximately 19% or so in 2019 up to about 28% today. But with AI coming through as well, we anticipate that there's going to be greater volumes within certain product categories. It's not going to mean that people buy more groceries, but within other sectors, and obviously leisure is one, as you allude to, but actual logistics sectors, perhaps beauty products, for example, if you're trying to compare different products, having those AI salespeople essentially on these platforms like Instagram will increase the amount of volume of e-commerce from our research.
Yeah. Susanna?
Not that much to add. The efficiency argument is very, very clear. So during due diligence and underwriting processes, it's definitely something that that helps. I think about the sourcing and origination part of private markets in general. I think that is much harder to replicate. It's still a people's business. So I think Claude will find that part more challenging. So I think there are limits to how far you can go, especially on the first part of the value chain when it comes to investments.
Yeah, no, I'm conscious of time. So maybe just to close off a couple of questions. What is the one widely held belief about real estate investing today that you think will prove wrong over the next couple of years? Or what are you most excited about as you look at the investing landscape today?
Shock horror, I'm going to say logistics, last mile. I think, in terms of widely held beliefs, definitely, I think a lot of investors see logistics as a mature sector, which I disagree with. I think the cap rate compression has come out of the market, but actually it's a real opportunity now for those that do have real expertise to show that. And, we've got a deep team and we're looking forward to proving it. And I think some of the deals we've done the last year and 2 years will actually probably be the best deals we possibly ever do. There's an incredible opportunity right now within certain sub-markets because it's very fragmented. There's a lot of high net worth individuals that we deal with day to day who, maybe they don't have the money for CapEx, they don't have the ability to improve the assets up to the ESG requirements of a lot of occupiers today. So I'm excited about us essentially losing a lot of competition and having an opportunity to scale the business further.
Ricardo.
Well, I would say the operational, right? Then people think it's niche, whereas I don't think it is niche. It's just that the volume of trade is low because it's in family ownership, not institutional ownership. So we did recently a sizing exercise of the universe of asset in our target market is over $1 trillion. So it's things that people don't know that exist because they're not in institutional, and we are typically operating in an institutional bubble, but being able to go and source the champion, and Claude won't help you. It might help you creating a list, but then you need to go and try to unlock this opportunity. Well, 80% of what we do is off market, but truly off market in the sense that you need to go and approach the owner and create the deal maybe over even a year of work and so on and so forth. I think that's where it's really exciting, and we feel that in some other sector there's only lever beta left because they're too crowded.
I think there's a pretty exciting opportunity set for private markets in general, particularly private credit. If I just think about infrastructure in Europe, right? Big investment programs, defense is another hot topic that will require both the public and the private markets to come together to finance this effort. And then we have kind of more flexible capital solutions. I think that will be an interesting part of the market as well, especially if you think about 21, 22 deals that are coming up for refinancing. Some of those transactions have been originated in a much more benign market where you had higher valuations, more optimistic views about the market. Cost of capital was super cheap, leverage is high. So it'll be interesting to see how that pans out, and at the same time, it will be a good opportunity for managers who have the risk appetite and the flexibility and expertise to structure around this and to provide capital solutions. So I think there's a lot going on here, and we'll see a very varied deal flow across the different asset classes over the next couple of years.
Great. Well, good to hear that the dispersion in the market is still creating a lot of opportunities, both in specialist and broader sectors. So I'd just like to thank our panelists for the discussion today.
Thank you.